Why don't we get into some of these things that you talk about in chapter 5? So double tax and RSU shares. Once you know to not get double tax, it's bad enough you're paying tax. Don't do it twice. Explain what's going on there.
And we see this a couple times a year amongst the client base, and we hear about it a lot, that somebody will say, I had this giant tax bill. I don't know where it came from. And we'll go through and look, and we diagnose the problem. But let's maybe start with what an RSU is. A restricted stock unit, an RSU, when those shares vest, that money that you get, the value of those shares on the day that the company transfers the shares to you and puts them in your stock plan account, that is income to you. It's taxed as ordinary income.
Even though you're holding the shares in your account and, living check to check or something, right?
Yeah, that's right. The shares get dumped in your account, and the value of those shares is whatever the market price was on that day for that company times the number of shares that you received. That amount is income, and it gets reported to you on your pay stub and on your W-2 at your end.
Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today I'm with Bruce Barton, who is the founder of Parkworth, which is a Silicon Valley-based wealth management company. He's also the author of a very cool book. I've got my signed copy right here. We hung out for a couple hours last week in Silicon Valley. It's called Personal Finance for Tech Professionals in Silicon Valley and Beyond. And in today's podcast, we're going to tap into the mind of this guru who helps people plan for retirement, but also not pay tax, not be double taxed on your RSUs, and a whole bunch of things get complicated in some of these acronyms like AMT tax. So I want to dive into that stuff, but we're just going to start with maybe like a high level, general conversation. So Bruce, thanks for making time again to hang out with us here.
Hey, Andrew. Yeah, good to see you. I'm glad to be here.
Yeah. So before diving into how to not, make just irreversible mistakes, which are completely preventable, like paying double tax in your RSUs when you're selling shares, that's like stuff we just have to go through. I think you get into it pretty well with chapter 5, and there's a lot there. We also have some links to some blog posts that you've written that, kind of lay things out. But, we were talking, earlier about, some of your clients show up in Silicon Valley. And it's like, I always make the metaphor that it's like Hollywood. They're day one in a movie and they're like, oh, how could my role ever end if I'm on a roll? But maybe talk about some of your clients that start off stepping into something good and then all of a sudden things change.
No, it's true. And there's this recent period we just lived through, post-COVID, just tremendous explosion in all things. And then, ground zero with AI in November 2022. We had a couple of folks that, just fresh out of college and first job as software developer, and boom, they hit it, $2 million in their first company. And they're thinking, wow, this is fantastic. This is easy. What was everybody so worried about? We'll just keep doing this the rest of our careers. And you have to kind of impart the wisdom from being through a few of these cycles that, no, this has been an extraordinary time. One of the outlier times. It hasn't been like this since, late 1990s, 2000. And you got to take care of this money. Yeah, if you do the proper things, you'll be set. Your retirement's pretty much guaranteed. You're so young, you'll grow that money exponentially, and you're done. Keep working, obviously, keep expenses under control. But you got a good head start on life here. So, but please realize what an unusual time period this has been, and it seems like, just here more recently within last year, we're kind of having the swing back to, a less exciting time. We've got other folks that, have been through a few cycles in the Valley that, maybe are in career transition right now. Startup didn't work out. Big company, is going to downsize a little bit. So what happens? It's a super volatile industry, super volatile career path. And we always like people, like maybe your startup's going to work. That's fantastic. Maybe it's not. Let's have a backup plan. Let's just do the prudent things.
Yeah.
When you have a win, take your winnings off the table, invest them, keep saving, keep your expenses under control, and just plan for a volatile ride.
Right. So plan for the best and plan for the worst at the same time. I think that I remember early in my career, I realized that people really barely, the software engineers hardly stayed in the same place for more than 18 months. And you think about it, if you're working for the big, large tech corp and you think you're playing it safe, like I work at Google or Microsoft or Facebook or something, the minute there's an economic correction, they probably have a solid 10% of the fat that they want to fire. And I know from having had hundreds of employees myself when I was a young guy, there were certain employees we had to have like two lawyers in the room while terminating this person. They're like a triple protected, quadruple protected, minority or something. And like, you just can't have a problem. When all of a sudden the stock market crashes by 30%, you're like, hey, I'm sorry. It's just, we have to let people go. It's not you, it's me. And there's a whole lot of, terminations that are going to happen. And you can even be unfortunate that they say, hey, we're getting rid of all this VR nonsense and we're going to get into AI. And so your whole kind of VR team can go. Maybe, like video on demand is no longer core at Oracle. So I think that at the big corporate, it's maybe not as safe as you think it is. And in the startup world where I'm at, it's like, look, this is either going to be a success or it's going to fail. And either way, if it gets acquired really quickly, they may not want to keep you, your client, in the new co. Maybe they don't need the CFO. So you're CFO of this hot fintech company. Success could be getting kicked out.
I mean, there's so many things that can go wrong. The product doesn't work. Nobody wants to buy it. But then there's just external changes that can happen too. I think we talked about my 3 startups were all in telecom back in the day. One of them, we were building the largest capacity, highest capacity remote access concentrator ever. The things when we used to have dial-up modems and you dial into. Well, we had the biggest one. Modem banks. We had the biggest one that had ever been built. Right as DSL and then cable were coming online in a big way. And so the whole market for remote access, dial-up access just disappeared overnight.
Yeah, it was time to get rid of the modem bank, and you guys made the biggest modem bank.
Right. And it was fantastic, and it was very successful and got acquired, and it was just in time.
Okay, good.
Yeah, that was all great. But it just, there's so many things that can happen with products, with markets, with customers.
Yeah, so the only certainty is that change is guaranteed, in Silicon Valley and the world of technology today. Well, why don't we get into some of these things that you talk about in Chapter 5? So double tax on RSU shares. Once you know to not get double tax, it's bad enough you're paying tax. Don't do it twice. Explain what's going on there.
Right, and I wrote a blog post about this. It was the most popular blog post I've ever written by far, and really struck a nerve with people because. And we see this a couple times a year amongst the client base, and we hear about it a lot, that somebody will say, I had this giant tax bill. I don't know where it came from. And we'll go through and look, and we diagnose the problem. But let's maybe start with what an RSU is. A restricted stock unit, an RSU, it's a promise by the company to give you some shares in the company, to actually give you the shares at some point in the future after you meet some requirements, vesting, typically time-based. You work in the company for, 4 years, and we're going to give you some shares quarterly. And unlike stock options, you don't buy these shares. The company just hands them to you outright. So RSUs, they're very nice. It's a very simple form of equity compensation, and companies and employees really like it. But some things about that are that when those shares vest, that money that you get, the value of those shares on the day that the company transfers the shares to you and puts them in your stock plan account, that is income to you. It's taxed as ordinary income.
Even though you're holding the shares in your account and, living check to check or something, right?
Yeah, that's right. The shares get dumped in your account, and the value of those shares is whatever the market price was on that day for that company times the number of shares that you received. That amount is income, and it gets reported to you on your pay stub and on your W-2 at your end.
And even if the RSUs are essentially, I mean, how does that work time-wise? So it's day one for me at Google. I get $1.5 million RSU dollars worth of RSUs because I'm great. When are they true? I mean, and what is it? 12 months for a cliff, and then every month over 36 months?
Very common, just like in the old days with stock options. Typically 1 year cliff, and then
monthly.
it's more quarterly vesting
Yeah,
now.
it's quarterly. Because some of our LPs, I jokingly say, they go to the ATM, the RSU ATM every quarter, and they can fund their capital call into RVC fund. That
Yes.
that's what
Yeah, you
that's
see
what seems to
monthly,
be happening.
you see quarterly, we see a mix. But there's no income tax consequence to you when you get the grant. There's no tax then, only as you start to vest. And so as you know, as each chunk vests and you get those shares delivered to your stock plan account, that is income for you. It's reported on your pay stub. You pay payroll taxes on that, Social Security, Medicare tax on that as well. And that's great. So the double taxation comes in. Let's say you're holding the shares, they're in your account, and you say, you know, either you do it immediately, which is often what we recommend. Companies hate this, but we often recommend just sell those shares right away. But let's say you decide to keep them, you keep them for 6 months, and then you sell the shares. All right, that's great. Well, tax-wise, you already got taxed on the value of the shares up to that market value when you received them. So just to give an example, let's say you received $10,000 worth of shares, 1,000 shares, $10, 10,000 of income. Your cost basis in those shares is $10,000. So they're sitting in your account and you've paid $10,000 for them, or you get credit for paying $10,000 because you already paid the tax. Now, 6 months went by, the shares appreciated. Now they're worth, say, $2,000 more. And you sell those shares. Good. And then you forget about it. And at year end, you send your stuff to your tax preparer, you get out TurboTax, you start filling out TurboTax, and you get the 1099 form, 1099B from the brokerage firm that records the sale of those shares. And there's a little box on there, box 1E, that's supposed to record what the cost basis was for the shares you sold. Because of course you're going to pay tax on the value of the shares you sold minus what you paid for them or the cost basis. And that difference is what you're going to pay tax on. So what should happen in this case is you've already paid tax on the first 10,000 because it was in your pay stub and you paid tax. And then this next 2,000, the gain, while you were holding them, that should show up on that 1099. It should show in box 1E, it should show $10,000 of cost basis and $12,000 of sale. So an additional gain of $2,000. That's how it's supposed to work. What can happen, we see it happens, I wouldn't say regularly, but it happens often enough that you definitely need to check. That box 1E will have a 0 in it. The brokerage firm will, and I don't know where the breakdown happens, at the company or in the brokerage firm, but somehow that'll get a 0 in it and they won't record your cost basis. They won't record the tax you've already paid or been given credit for. And so you will go just happily along. I'll record the $12,000 sale on my tax return. My cost basis is 0 because that's what it said on the form. And you will pay tax on $12,000 of income. And you've already paid tax on $10,000 of income.
Got it.
So you will pay tax twice.
So the key thing for anybody listening to this, anyone with RSUs, is to really microscope, zoom in on the cost base, on the gain. That's the trick.
Right.
Zoom in on the cost. What was my cost base? Like, what did I pay for the stock? And what's the gain? And I'm paying tax on the gain. And I already got paid on this 10K scenario.
That's right.
And what happens when you get RSUs vested into your account? So you can now walk away if you leave your job with whatever's vested, right? It's in the account and the stock value goes down.
Yeah, that's right. Once those shares vest, you own them. They're in your account. You can do anything you want with them. You can sell them. You can move them out of your stock plan account, move them over to your, retirement savings account that you have at your other brokerage firm. But the value of those shares just fluctuate. And if the share prices go down, then, the value of those shares are less for you. If they go up, they go up. That's fantastic.
But you don't lock in tax for that tax year at the time that you get them. I mean, what if you got your RSUs at I don't know what a good example of a company, but like, Putin invasion, April 2020, everything kind of went down, right? What if you got your RSUs into your account in March, and then by April they're worth 40% less?
Right. So you're still going to get taxed on the ordinary income when you receive the shares. And then when the price goes down, if you sold them while it's down 40%, that's a short-term capital loss. So at that point, the rules just follow the normal rules for capital gains and losses. If you hold it for a year or more, it's long-term capital gain or loss. And if it's under a year, then it's short-term capital gain or loss. Short-term is taxed just like ordinary income. Long-term, there's the special discounted tax rates for holding for a year or more. So in this case, you'd have a short-term loss, and you can deduct that against any gains you have, capital gains, or up to $3,000 a year you can take on your tax return, even if you didn't have any gains.
Yeah. Well, many years ago, when I was in the Valley, I was running the Founders Club, the Venture Capital Equity Exchange Fund, and then people started selling stock for cash, and even early employees. I was helping early employees sell, and so I was under a broker-dealer, FINRA supervision. It was terrible, but people would come to me in those days and say, "Hey, Andrew, can you help me? I've got this crazy AMT bill," and at the time I didn't even know what they were talking about. And they say, "Can you believe this? I've got to pay cash to the IRS on some of my stock of my company, even though I haven't quite sold any yet." It was all a little confusing. And bottom line, they had to sell something. And so, there's a couple companies that really come to mind for me now that I remember, where these guys were often the founding CEO even, and they had to sell something on the secondary market, which I helped them do, in order to cover AMT on ISO exercise. Can you explain what's going on with that?
Yeah, you hear these stories floating around a lot. For people that've been around the Valley a while and have worked in startups. Typically, startups are issuing incentive stock options. That's the first form of equity compensation. Well, founder stock, and then ISOs to the non-founder employees. And an incentive stock option, the way those work is, no tax consequence when you get them. When you exercise them, no tax consequence. And when you sell, depending on your holding periods, if you hold it 2 years from date of grant, 1 year from date of exercise, you can get long-term capital gains treatment.
Which is, just slow down for a second, so make sure we didn't lose anybody. So company's got a cap table, pizza pie, 100%. Founder A, founder B, they each own 50%. Then VCs like me come along and start buying. So there's this. Then they create an ESOP, an employee stock option pool, right? And that's what we're really talking about here, right? So you got founders have their founder stock. They might even be put on a vesting schedule, but that's a whole nother episode to talk about. But the other employees, they're given these, rather than giving equity in the company, which would be a taxable event, and it's, they get the employee stock options.
Yep.
And there's an exercise price. So if they're vest, they don't really have to buy them or exercise them. They just keep letting them vest. So there's no real account like the RSUs. So maybe 20% or 25% vested after 12 months, and then it's monthly on a cliff. But let's say that they're leaving the company and now they want to vest, or what is triggering the issue here?
Right. So and this is specific to incentive stock options, ISOs. There's other kind, non-qualified stock options that have a different tax treatment. They don't have the special tax treatment that ISOs get. ISOs have these special rules, and it's really important to know which type of stock options you have. A lot of companies, if you get there early enough, they'll start you out on ISOs, and then later they have to transition to non-quals because there's some limits in the tax code. But anyway, it turns out that there's really two tax systems in the United States. There's the regular tax system, which people, are pretty familiar with, or some people are. But then there's the alternative minimum tax system. So unbeknownst to you, when you go calculate your taxes on your tax return, you're doing two calculations. You're doing one under each system. So you first do the calculation under the regular tax system. The software in parallel is doing the calculation under the alternative minimum tax system. And if there's a difference and you owe more under the alternative minimum tax system, that will show up on your tax return, which is recording taxes under the regular tax system. It'll show up as you are going to pay AMT. So that AMT on your regular tax return, that's really a delta. It's just a difference between the two calculations. And it turns out, I know this is complicated, I'm going through fast, but the ISOs are treated differently under the alternative minimum tax system than under the regular tax system. Under the regular tax system, when you exercise the ISO, no tax consequence. But when you exercise the ISO under the alternative minimum tax system, that is a taxable event, and you owe tax under AMT. So what happens to people is, company stock's doing fine. They go ahead and exercise some ISOs that triggers tax under AMT. And a lot of people are not aware that this happens. They think I'm good under the regular tax system, no tax, but under AMT, there is tax. Difference between current fair market value of the company and the strike price. And then let's say, and we're in a public company now, let's say later in the year, the stock price drops. Well, you don't get a get out of jail free card on that. You still owe the tax because you exercised. So you might have a giant alternative minimum tax bill. And, maybe you're not going to sell the stock. Maybe the stock has dropped so much, there's not enough value in the stock to actually cover the tax bill. And this is where people get into trouble. This is, what the folks that you were talking to, why you were having to sell stock for them, because they triggered a big AMT bill, and then probably the stock price dropped, and then they had to, they're looking at this giant tax bill and having to come up with cash to go pay the tax bill.
Yeah.
There's a lot to this. One of the things you could do, and one of the things that we always recommend, and people familiar with stock option problems recommend, is for your ISOs, try to exercise early in the year. Because if you have a disqualifying disposition, if you sell those shares within the same calendar year, then the AMT tax treatment disappears and it just becomes regular tax. So you'll just have regular ordinary income tax on whatever gain there was between the sale and the strike price. So oftentimes we recommend, if you're thinking about selling ISOs, do it early in the year so you have enough runway to see if the company's gonna, prevent the stock price from tanking later in the year. That's the safest thing to do.
Okay.
Yeah.
Okay. And you've got like ISO exercise and QSBS. Do you relate the two together? Or I guess that's, qualified small business stock. That's something that we pay a lot of attention to. And I think most VCs are starting to understand what that is. Do you want to explain what QSBS is and how do you see that relating to ISOs? Because
Yes.
in our world, we just invest in the company and say, we've been in it for 5 years. What was the instrument upon which we entered into the deal? Was it a convertible note? Because the clock doesn't start ticking on it. But why don't you back up and explain to everybody, what does QSBS stand for?
Yeah, I mean, for individuals, this is a tremendous benefit. And it's shocking how many people don't know about it yet. CFOs don't know. I think the community is starting to catch on to it a little bit. But QSBS, qualified small business stock, there's a provision in the Internal Revenue Code that says, if you bought stock in a small company, and it meets particular set of criteria, then the gain you have on that stock is tax-free up to $10 million.
Or 10x your cost base.
Or 10 times your cost basis, yeah.
So if you wrote a check for I think $45 million into a company with less than 5 million under the balance sheet, you're under the 50 million requirement, and you would pay zero tax on your first 450 million of gain. And that's if you did it directly in the startup as like an angel or a super angel. And it works if you're an investor in our fund.
Yes. Right, exactly. Yeah, the kind of, as I recall, the rules are the company has to have 50 million of gross assets at the time the stock was issued.
Or it's got to be under.
Under 50 million.
Yeah. So the pre-money valuation could be ridiculous billion-dollar valuation. It's the balance sheet, which is inclusive of the financing, because like the cash that we're putting into the company is considered instant balance sheet as measured by, does it meet the qualifications for qualified small business stock exemption 1202? And so it's just 50 million. A lot of the companies we invest in don't have smokestacks or laptops that equal $50 million worth of, balance sheet stuff. And, where we're playing in the market, we're not writing $45 million checks anyway. So it's basically 10x their cost or the first 10 million of gain, whichever is bigger.
And there's other ways you could, with trusts and other things, you can, as the individual, you can create more than 10 million too. So
which, by the way, let's go back to that. Because I know about this, but we haven't spoken about this on the podcast before. That's kind of new information if anyone's listening to everything we talk about here. So if the company has under 50 million on the balance sheet, inclusive of the funding round that's happening right there.
C Corp, works in the correct industries, which most tech companies are.
Right.
And there was some deadlines. This law was 25 years old. So, but basically anything currently, yeah, you're going to get the full exclusion.
Yeah, there's like 93 or something this came into being or something. And so that means if you invested directly as an angel on the cap table, or if you invested into a VC fund and you're a US taxpayer person and the fund invested, when you receive your distribution from IPO, exit, M&A, or selling on the secondary market, if you held the stock for 5 years and a day, you pay zero tax on the greater
Federal.
of the first 10 million or the 10x your cost base. And then it's state by state, it's different. California is not the greatest.
California doesn't conform to the federal law. So in
Yeah.
California, you're still going to pay.
Anti-constitutional, but who are we to fight them?
Right. But some states do. Like I looked up, we had somebody in Colorado that had invested in a side venture and turned out that was 100% tax free.
Yeah.
I looked at Georgia. I think Georgia was.
New Jersey. I know I think most states are pretty cool with it. California's like, oh, you guys will never leave. The thing about New Jersey, like it's like illegal to have self-service gas. Like they just want like total employment, like it's East Germany in the good old days. And in New Jersey, they say if the jobs are created here in New Jersey in the Garden State, hell yeah, no one pay tax. But we're not giving you tax free to make jobs in San Mateo.
Yes. I don't know personally. I haven't done one of these, exotic trusts to allow yourself to get more than the 10 million. So, if you think that the company might be worth more than that, you should go see, a estate planning attorney that is very familiar with this area to create some trust to, work that exclusion and get more. But sorry, Andrew, I didn't answer your question. The thing about people are not aware that you have to actually have purchased the stock. You have to buy the stock. If you're holding incentive stock option, you think I've held it for 5 years. I'm sorry, that didn't qualify. You have to exercise and hold the stock. And I've had a couple of sad conversations with people about that who weren't aware of that. So I wrote the blog post about that because I think people need to know that. So if you get an ISO grant, hopefully it has hopefully you can early exercise, so you can exercise the shares ahead of the vesting schedule. Just exercise all now, file your 83B. But that starts the clock ticking on QSBS. It starts your 5-year clock. Super important.
Yeah, I think that the 1202 tax code, I actually have read it more than once because there's a debate among lawyers in the Silicon Valley if a safe note starts the clock ticking on 5 years. And for some people, they say, well, 1202, if you read it, it's for primary issued stock issued by the company, paid for with either cash or some other in-kind thing. So it could be I'm an employee, so I get it for my work, I guess that means. But it definitely is clear that if you buy a secondary, so if you invested in a startup and my fund wants to own a higher percentage, and then you say, hey, I love the new valuation, Andrew, you can buy out 50% of my shares. I paid that money to you. It goes into your pocket. It doesn't go into the treasury of the company to pay for payroll and create jobs. This whole thing is kind of Jobs Act stuff.
Correct.
So,
right.
so the secondary, you definitely don't get QSBS.
That's my understanding.
I think a convertible note has a maturity date where it can be redeemed as a loan, and there's an interest rate. That is not buying stock. So until your convertible note converts with a bona fide financing or a change of control or something happened that you converted into being a stockholder, I think that definitely qualifies. The clock begins ticking when conversion happens from the convertible note. But convertible notes, you're not playing the QSBS game. A lot of people would say clearly the safe is not primary issued stock. I personally think it is, but I tell RLPs, if we're within 5 years of the date that we wired and signed on a safe note, simple agreement for future equity, there is no way to get the money back. There's no redemption. There's no interest rate. It's not debt. It is equity. That I say, YC only came out with this stuff, a few years ago, and we've only been in the 5+ period of, we're in like year 7 or 8 of the safe being in existence. and the court, it's never gone to the courts. So my view is they should keep their wealth managed with someone like you who's smart and say, this is the calculated tax you would have paid had it not been for QSBS. Let's keep that in some kind of CD, marketable securities, really safe. So let that money grow for you if there's ever a clawback on it. I wouldn't just voluntarily pay the tax on it. But that's a debatable issue of, do safe notes qualify? Convertible notes, definitely not.
That's right. That's what I hear from the attorneys too, that are really up on this stuff, is that, there aren't any court cases. It's not been litigated at all. So yeah.
And it may never get litigated. That's why I say calculate your tax you would have paid on the gain of you were on a safe note for 2 years and you only had 3 years after that conversion. This is where some people would say, I just want to pay the tax, and other people say, I'm going to keep it in a rainy day fund. I think it's a little risky just to go spend that money and then be potentially facing a clawback if people come after you.
Right, right.
I mean, how big are you? Are they going to come after you? But you want to do things by the rules here. Okay, so I guess we covered QSBS. What is the 83B election and why is that important?
Yeah, this is really important for founders, in particular. If the company gives you stock when you set up the company, you give yourself stock. If you get the stock outright, that's a taxable event, but the value of the stock was not anything at that point, so you have a few dollars of tax, no big deal. Where the issue comes in is if there's a vesting schedule attached to that stock, it becomes restricted stock. And what happens is, over time, the value of the company will go up. So let's say it's a standard 1-year cliff, 4-year vest. At the end of the first year, the stock is now worth more, and you actually own the shares because that restriction is gone now. The time restriction is gone. You have vested that first year. So that the value of the shares now is income to you at that moment. So maybe it's worth 50,000, maybe it's worth 200,000, maybe it's worth $500,000 after a year. You owe tax on that, and you may not have any assets to pay the tax because you can't sell the stock. You're still in startup mode. You may have to pull assets from outside sources. You may have to dip into your portfolio to pay the tax. So what you prefer to do is, what the 83B election allows you to do is you're basically instructing the IRS, I want to be taxed on the full value of the stock now, not at the end of the 4-year vest, but the full value of the stock now, and I'm going to pay the tax now. And then as you vest, no more tax is owed on that kind of initial piece that you got. There may be some tax owed later when you sell. There's some capital gains, but at least there's no tax owed as you vest.
Okay, so the issue here, and I was shocked as the founder when this was happening to me. I'm like, hey man, this is my company. How could you possibly do this? Is that they put my founder stock on a vesting schedule. And we see this, now that we're on the VC side of things. The concern is if you have like 3 founders and the VC invests and buys 20%, whatever, of the company. And so the 3 founders have been diluted by this, sale and issuance of shares. But one of them just says, you know what? I've got another job opportunity or another startup I'm going to go off to, and I'm going to leave, and I'm taking with me my like 20, 30% of the company that I own. And so you want to kind of put golden handcuffs on the talent and make sure that they're committed to staying at the company for at least X period of time. So kind of like, I know a guy who was, I won't say his name, he was a general partner at a multi-billion-dollar VC fund on Sand Hill Road. He then decided, I want to be a founder. So he leaves the fund, starts his company, did it by the book, put himself on a vesting schedule for 4 years. And on the day of like his, 4-year anniversary, he actually put someone else in place, left the company. And the moral of this story is then like the board went crazy and like pushed him down to 0. And so like the moral there is never leave. But he was on a vesting schedule. So if you've got these 409A valuations where, the founders want to keep the 409A valuation as low as possible. So when you issue stock options, the strike price is as low as possible. So their options are in the money and they have golden handcuffs. But if you're the founder, technically your founder stock had zero value or 0.0001, price per share. And so Oric does the docs and you pay like $25 maybe,
Right.
right? It's a nominal Starbucks,
That's
income expense
that's the
there.
easy case. Where you get into trouble is with that vesting schedule, because then you get, as the company value goes up, you owe tax on that money. So you want to elect to be taxed now, and that's what the 83B election does. A lot of the venture lawyers are really good at this now. They include it in the packages, but a lot of people ignore it. Like, I don't know what this is. I can't read all this stuff. But you should not ignore the 83B election when they tell you to do this. They are doing you a kindness, and you should pay attention to
Okay.
them. And
So lock in the lowest tax basis you can as the stuff is vesting,
yes, and there's a deadline.
which could potentially be, and if it's vesting monthly in year two,
yeah, it could be
you just do it at the end of the year.
huge tax bill. So the thing with the 83B is there's a specific deadline. It's 30 days from the day you get the shares. World today, we're all like, oh, can you just cut me some slack? No, it's no exceptions, 30 days,
Okay.
30 calendar days, not business days, 30 days, no exceptions. If you miss it, you pay the tax. So do not miss the deadline. The other ththing weird about 83B is there's no IRS form for it. It's just in the code, in the IRS code, the information that needs to be included on your election. So the venture attorneys are pretty good. They've created a form for you. So use that. I mean, some of the doc packages, I know Clerky and Cooley Go has it. So, those doc packages have it. But, make sure you use that thing. It's going to save you a ton of tax.
Okay. And having spent your life, I mean, you've got your own stories of 3 startups in Silicon Valley, but now advising 95 families or whatever it is these days. What are some general advice on saving, building wealth, retirement? We've dove into the weeds of some of these ATM things that can bite you, but what are some general overall advice?
Yeah, I guess, what we started with was that this industry is so volatile. Just don't let it go to your head. If you have a big win, maintain your kind of spending posture. You're in this thing for the long term, unless you're done, but fine. But even then, it's hard to know. When I first started doing this, one of the very first clients we had back in 20 years ago had about $12 million net worth. And, being new at this, I'm like, oh, fine, they're going to be golden. But as we got into it and actually did the analysis, well, it turned out there was 2 properties that weren't income producing properties, a nice home, a second home. And so that left, about $6 million of assets to support their lifestyle. Lifestyle was about $500,000 a year. And it just didn't work. They were not going to be able to maintain that. So it's really hard once you kind of get out of the mode of, I have a paycheck, I know how much I spend every month, I'm able to save some from that. Once you get into the kind of ether of, I've got, I'm a decamillionaire, it's you get untethered from the reality of how much you can spend, and you actually have to go do some analysis to figure out. I can't even tell. I mean, I've been doing this 20 years, and I can't tell when someone walks in how much they can spend. We have to run it through our tools to find out. So it's important. It's like the most important thing is the spending. As we do financial plans for people think, well, I'll make it up with a little extra income. But what happens is income stops after a period of time, but those high expenses go on forever. They're just, it's a lot more weight on the scale. So
Yeah.
you got to know where you're at. You got to get your bearings. And it's easier when you're working, just save, keep your spending under control. And, if you hit it big, you still got to go have somebody take your bearings for you, because it's really hard to tell without doing some math.
And I guess, for the reason, I mean, you specialize in tech, possibly just because of where you are physically in the middle of Silicon Valley, but with what's different there is there's all this equity compensation and the volatility of,
That is the main
big
difference.
riffs at the big companies. Even a good outcome startup gets acquired. Sometimes with the way the liquidation stack works, that, like I've seen this happen where you're like the head of sales building a great company all over the world. You're like diamond on 10 airlines because you travel all the time, 12-hour flights. And then somehow the VCs got 90% of their money back, and then 10% was carved out for the top couple of founders, and it didn't come down to you. And you're like, how is it possible that, this didn't pay out? So there's a million different ways to lose.
I think that's another, I'm going to add that to my thinking now, because that is another area of volatility that I don't like routinely think of, but just sort of the structural risk of being in a startup, and what can happen with different investors, and what happens to you as a founder or executive.
Yeah, I mean, you have something called the participating. There's participating, non-participating liquidation preferences, and I remember the first time this happened to me as the founder, I was a little skeptical, but then it kind of made sense that, let's say that you and I own a company and we're a bunch of 14-year-olds, and then some nice investor comes along and puts $1 million into our company and owns 20% of it. They don't want us to turn around and sell the company for 500K cash and then we split our bit and walk off. So to prevent that from happening, they're saying, look, here's $1 million. I trust you two 14-year-olds to do the right thing here. In the event that the company is acquired or liquidated, I get my $1 million back 1x. And after that, it's pari passu. I get 20% of any exit consideration. You guys get 80, split two ways. And sometimes these can get a bit more structured, in bridge rounds or in weird times or provincial locations around the country or the world. But, if the company has raised $500 million and it's been a while, it's like over a period of time that there's a liquidation stack of 500 million bucks. And these people work, as the head of sales for that company, thinking she's building a great company and there's going to be a payout. What is a realistic valuation of that company in an M&A scenario? It very well may be that we're all working so that the investors can try to get to 1x.
Right.
And they might be willing to cut in core management with a 10% management incentive plan to get it done. And so even success can be hard with having all your eggs in one basket and spending a long time at one of these startups. And sometimes when the company gets acquired, they might really want you to stay at that company, or they might not.
I think that's right. That is what's different about this industry. I mean, it's wonderful that people working in tech have these opportunities to build wealth, because it's way easier than maybe in other industries where you just save some money in your 401k. But here you have options. You have RSUs. You have stock options. There's ways to build wealth. You have liquidity events. It's fantastic. But treat it as the opportunity it is. Take that money off the table, save it, put it in your long-term retirement portfolio. Make sure you're safe. And just keep accumulating, and then you should be fine. But don't let it get to your head. Don't increase your spending after you had your IPO.
Yeah. I think, take a network perspective. I think one of the great reasons for living in the Silicon Valley is that the density is so high that you go to your kid's lacrosse game and you end up selling a company on the sideline. That or they invest in your company, whatever. Something's happening there. That try to do as many people favors as you possibly can. And it may be that the thing you've been building doesn't work out so great, but you're pretty damn lucky. You got a little bit of this one, and this one. And you deserve it because you were helping people along the way and making connections. But listen, Bruce, great to see you again. Hope to see you again real soon. Thanks for sharing this wisdom. And paying tax once is fine. Paying tax twice, it's your problem.
Thanks so much, Andrew. Yeah, looking forward to seeing you again.
Okay, see you soon. Bye for now.
Bye.